Okay, we're going to go through this last part here on chapter 17. Again, I apologize. Uh, I've had some very serious technical difficulties that are unfortunately beyond my control. Uh, and I'll try to go from there. We talked about the accounting cycle and the 6 steps in the accounting cycle, which you can see at figure 17.4 on page 480. We have a bookkeeper, and we need to look at the bookkeeper's role in the accounting process. And the bookkeeper, whoever he or she is, they're recording the transactions in these journals. And the divided firm's transactions noticed into meaningful categories. So they have to be for sales, they have to be for payroll, they have to be for whatever it is. And in the old days, they did this by stubby pencil. Today, we usually use a program, and the program is called a journal. We use, bookkeepers use what's known as double entry bookkeeping. That is, they record all transactions in 2 separate places. And this is a check and balance type thing. And the object here is accuracy. And you're working with figures, and it's easy to get them transposed. So that's something that you want to make sure that you have in the right place. The bookkeeper uses a thing called a ledger. Don't be confused about this. This is just something specialized that's set up for accounting, and where all the information is in one place. Remember, it's going to be double entry. And then what they do is send a trial balance. Think of this as a trial balloon. See if it goes where you want it to go. And if it's going to give you the information that you want it to give you by what you have recorded. So this is a summary, if you will, as the slide says, of all the information in the accounting ledgers. Technology and accounting, I'm not going to spend too much time on that. There are a number of computer programs, especially for small businesses. There's one called QuickBooks. There's another called Peachtree that will really help you do those things, and they do them obviously a lot quicker. This is the balance sheet. This is very important that we keep this and have this set up so we know what we have. This is the firm's financial statement, if you will. We could even say condition, but statement is a better way to say this, at a specific time. So that we have things that in there that are assets, and we have assets that are considered to be both tangible and intangible. Now, tangible is something that we all know that we can identify with one of our 5 senses. We can hold it, we can see it, we can smell it, etc. And intangible is something that is difficult to put a price on, but that's known as things like goodwill. It's trademarks. It's brand. What is associated with the brand, like a brand name like Coca-Cola or Kimberly-Clark, which is the maker of Kleenex, or Minnesota Mining and Manufacturing. Liquidity is the ease in which these assets can be turned into cash. So now we're going to need to classify those assets: current, fixed, and intangible. Now, intangible we talked about a little bit before. Notice what it says here, they're long term. So those are things, if you will, that are, at least in my estimation, I like to explain it, embedded in the firm's fabric. And no physical form, which we talked about before. We know that. Something we can't pick up or see or smell, etc. But they have value. There's things like our patents, trademarks, etc., which we spoke about before. Current assets, we can turn that into cash within a year. Fixed, those can probably be turned into cash if we want to sell them, but we may not be able to sell them for what we think they're worth because there's depreciation on them. And here we're talking about, now land may not depreciate, but property can, certainly equipment can, and things of that nature. Notice that they're relatively permanent. I think that's the way we have to look at them. Now, it's okay, we have liabilities, assets, we also have liabilities, and we have to think about how we're going to classify those, and they fall into the liabilities, things that we owe. It's pretty simple. But we have three categories here: accounts payable, notes payable, and bonds payable. Bonds, remember, well, I can't give you, remember, we haven't talked about that, excuse me. Bonds are long-term liabilities that the firm has a contractual obligation to pay back at a specific time, plus the interest that accrues on the bond. And we'll talk about those when we get to Chapter 19 in greater detail. Notes payable usually short-term, but often they can be long-term. Now, the reason I stress short-term is because for the most part, when people get into long-term debt, they're into bonds and not the other ones. And again, you have to pay these back at whatever the date. And then accounts payable are what we owe right today on things that we bought, and mostly we bought on credit. Now, owner's equity is the amount that belongs to the business minus anything we owe. And retained earnings is exactly what it says. It's things that we kept in the organization from our profit, and we intend to reinvest those in the business. Now we turn to the income statement. This is, as the slide says, and I cannot say it any better than the slide says, pardon me, this is our bottom line. Profits after all of our costs, expenses, and taxes. And then we come up with either a net loss or our net income. And we don't have to explain those. We certainly need to know what that is. Now, this is the formula. This is very important. And I want to go through this as it says on the slide so that you can read this and hear me say it at the same time so it sinks in with us. It's a very simple formula, but we need to make sure we get this in our head. This is whether you're in a business, working for a business, or you're going to run a business. If you're going to run, own, and operate your business, this is critical. Formula for the income statement is revenue is the cost of goods sold equals gross profit. Operating expenses equals net income before taxes, then minus taxes, and that's going to give us our either net income or our net loss. Remember, we have to get to this. We don't want to stop at gross profit. That's an incomplete picture. And this is just giving us a little bit more information on the accounts of the income statement. Remember, revenue is what we have coming in from our sales. Now, it could also be from investments. Could be from things like rents and things of that nature, other payments coming in. So cost of goods sold or manufactured. And then we have the gross profit or gross margin, how much we earn by selling the merchandise, how much we earn. But that's not profit. That's just how much we earn, how much we took in. We haven't paid our costs yet. Two kinds of accounting, and I'm not going to go into this a great deal, but you need to talk to your accountant and you need to have one system. It's either first in, first out, or last in, first out. And depending upon which one you do, it's going to change, or as the slide says, affect. Remember, affect here means influence income by ending the inventory and ending inventory evaluation, or valuation, I should say. It depends upon how you do that. Either way is acceptable, but you can't mix and match. If you mix and match, not only are you doing something that's incomplete, you may be doing something that's illegal. Operating expenses, that's what it costs us to operate. Rents, salaries, et cetera, et cetera. Now, depreciation is usually on big ticket items like equipment. And there is usually a government schedule, come out from the federal government. It says how you can depreciate a particular piece of equipment over what is, pardon me, what is considered the useful life of the equipment. Now you can change that. You can say, I want to depreciate quicker, or I want to extend the depreciation, and that's fine. But again, you can't mix and match. Statement of cash flow is exactly what it says. What comes in, what goes out. Income, disbursement. And that covers operations, investment, and financing. Cash flow, obviously, again, is the difference between what comes in and what goes out. I can't say it any better than what's on the slide. And you have to be able to manage. This is a critical thing for small business, managing cash flow. It's really difficult. And, you know, missing here, especially if you're in a seasonal business. And if you're in retail, it's very difficult too, because most retail sales occur around holidays, and there's great lulls in between. Now, I'm not going to spend a whole lot of time on these ratios, just to let you know that they're there, and that if you need some help with this, then you need to get an accountant. This assessment of the firm's financial condition, we can use liquidity ratio, leverage ratio, performance ratio, and activity ratio. This activity measures how effectively management is turning over inventory. One of the key things here to remember about inventory is if you have inventory stagnated on your shelves, for lack of a better term, or in your storeroom, for lack of a better term, it's costing you money. So you need to turn that over quickly so the firm can show it's making a profit. And you're going to find this on the balance sheet. There's talk about moving to international standards in financial reporting. We're not going to talk too much about that. And that brings me to the end of chapter 17. We'll take a short break now till 5:49 and come back and discuss chapter 18, which is financial management. Please come back at 5:49. Go a little bit longer tonight than normal. And again, I apologize for the errors. Okay, it's 5:49. We're back again. I want to apologize. We're only going to have part of chapter 17 and chapter 18 tonight, and to preclude possible further technical difficulties, I want to give you the lecture discussion question. And the question is, in your own words, explain why businesses need operating funds in 4 key areas. You'll find that in chapter 18. Again, in your own words, explain why businesses need operating funds in 4 key areas. Consult chapter 18 and make sure your responses uploaded to the forum section are in your own words. This is financial management, chapter 18. Let's look at the learning objectives, explain the role and responsibilities of financial managers, outline the financial planning process and explain the 3 key budgets in the financial plan, explain why firms need operating funds, again getting back to our lecture discussion question, identify and describe different sources of short-term financing, and finally identify and describe different sources of long-term financing. All right, what is finance? Well, this is all the functions that a business uses to acquire funds for various and sundry reasons, and then to manage them. Financial activities include what we see listed here: preparing the budgets, creating a cash flow analysis, and then planning for expenditures. I would say instead of creating a cash flow analysis, is making sure that you are able to analyze the cash flow. Now, you may want maybe want to create a system to be able to do that efficiently and effectively, and that's fine. This is a laundry list, if you will, of what financial managers are responsible for. Obviously, they will look at the data that they have. They'll try to analyze it and then recommend strategies for the folks that do the planning and then implementing the planning. And of course, as the tagline says, to improve the financial standing of the organization. They're responsible to pay bills, get payments, et cetera, et cetera. But last and maybe most important, ensuring the accuracy of the financial data that they're reporting or having reported for them. Rather than telling you who's who in finance, I don't think we need to be concerned as much about that. Is that 4 signs that you need a CEO or CFO, certified a chief financial officer, excuse me. You don't have the items that you need. You don't have the information that you need. You don't know about cash flow, working capital, etc. Nobody's watching the storefront, for lack of a better term. You've not kept up with regulatory changes. It's especially critical if you're a publicly traded organization. And even if you're not, there are tax changes through the code that affect small businesses. And then notice you can't generate the reports that you need. Really, really difficult for a small business. And it's very important that a small business have some kind of auditing, some kind of accounting help. Yes, it's expensive, but certainly something that you need to do. This is what the financial managers do. We won't go through this entire list. As a matter of fact, we may not even talk about the list at all. You can see this graphically displayed in your text at the top of page 505, figure 18.1. And you see there's planning and budgeting, auditing, managing taxes, etc. Collecting funds is all part of that. These are the top concerns for a chief financial officer at the macro level. And let's just look at a couple of these. We need to make sure we're staying up with the federal government and changes in its policies. pressure coming from our competitors, the fluctuation of credit. Now, for many, many years here, the Federal Reserve had not raised the interest rates. It's now raised the interest rates. It just did so late last year, and it's expected, I've used the term expected, to raise rates 2 or 3 times in the coming year. A lot of that depends on how healthy the economy is, and the current president has a much different view of some of the facts and figures that the government provides on a monthly basis about unemployment and things of that nature. So we may see some changes here. I think this is all in a great amount of flux, because I don't think I think the figures that the not the Federal Reserve, I said Fed, and that usually means Federal Reserve, that the federal government reports are accurate. What I think is that we're not necessarily getting the facts and figures that give us a holistic picture, and because we tend to look at the unemployment rate as opposed to some other type rates, some other type of facts and figures and data that are in there. So I think we need to figure that out. What we have here is a real contrast, and I'm not making a value judgment here, but we have a contrast between what the current president believes and what the government has been reporting for a period of years. What I'm saying here is the government, the folks that do this, the analysts, they believe they're doing the right thing. The president doesn't think so. The problem appears to be that there's been no direction given. And as long as we have this, oh, I don't believe what you're telling me, and they're saying, well, this is the data we have, there's going to be a disconnect. And that has to get fixed, because that doesn't help all of us. We're the ones that need to know this because we're affected. On the micro level, notice there's some things here. We have to be able to say what we're going to do and make accurate forecasts. And then we have to be concerned about working capital. And then we'd have to look at things like cost of healthcare, but it's more than just cost of healthcare. There's other cares and benefits that companies, pardon me, offer to employees that have to be considered. And it's more than just healthcare, although healthcare is a large, if not the largest piece of it. All right, financial planning. It's short-term planning, and we'll talk about this. Short-term planning of any kind, and I think we've mentioned it back in operations management, covers a period of about a year. Long-term financing is considered, to long-term planning and even financial planning is considered to be in the realm of 3 to 5 years. It is often extended to 10, and very rarely do you see it going out as far as 20, as I just said. So this is what we're doing. And then, so we have to be able to forecast what we need short-term, and short-term again, a year or less, and it could be in increments of 90 days. And then obviously long-term, as we mentioned. We have to have a budget that will meet that forecast. So that budget is a forecast. What we have, here's the forecast. The forecast usually should start with sales. This is what we expect to sell, and this, everything else falls into place. And we need to have some kind of budget. And then we have to have some controls on our finances to make sure that we're doing what we say we're going to be able to do. 3 types of budgets: capital, cash, and operating. So the capital is exactly what it says. It's big ticket items. It's for machinery. It's for equipment and things of that nature. Maybe for purchase of land, for purchase of buildings, et cetera, et cetera, et cetera. A lot of money we're concerned about, and so this is what we're doing here. Cash budget, exactly what it says, what comes in, what goes out for a particular period of time, usually a month or a quarter, and then of course we're going to roll that up on an annual basis. And then finally, the operating budget, or the master budget, it ties everything else together. And then this is our financial planning. We can see this again in the text. This is at the bottom of page 507, figure 18.2. We see the master budget in the center, and then everything flowing either into or out of, and all mentioned with that. But notice what goes around here, and I would like to see this more in a circle, is feedback. And feedback and evaluation. And so we are constantly reviewing what we have and going back to the chief operators in the organization saying, here's the situation, and making sure that we're giving them accurate, not only accurate data, but accurate information as well. Have to have financial controls. We just really have to know what's coming in, what's going out, et cetera, because if we don't have an accurate picture, we're not going to have to worry about short-term or long-term budgets because we're not going to get there. Now, here's key funds key needs for operational funds. We have to be able to manage what we do on a daily basis. We have to be able to get credit when we need it. We have to be able to get the inventory we need to produce the products that we want to sell. And then we have to make some capital expenditures to buy equipment, to buy maybe land, to buy buildings, etc. Very interesting thing here for our small businesses, how small businesses can do a better job at our cash flow. And I think the first one is try to get what's owed to you quickly as possible. And one of the ways you can do that is to offer a discount. Say, okay, this inventory for $100, and if you pay me within 10 days, you get a 1% discount. Now, that's not a lot of money. We're talking about taking $1 off, but it gets that money into your pocket a lot quicker. Obviously, the last one's stay away from using credit cards. And I don't advocate the one right above that, raising prices, because that's a real problem. Small businesses will find themselves in a big world of hurt if they try to raise prices. It's just, if everybody else is doing it, that's fine. But if you're raising prices because you need money, you're going to be in bigger trouble than you were before, because people just aren't going to buy it. Debt financing, getting funds through various forms of acquiring debt, loans, bonds, etc. Equity comes in from your own operations, maybe through sale of stock, etc., or from funds from the owner. Short-term and long-term, we've talked about this before. We're not going to talk about it to any greater extent. Now, here's why we need financing. This is a little bit different than what we talked about before, so we need to have just a little bit of look at this. And we can find this at the figure 18.5 at the top of page 513, short-term. Meet expenses. Now notice those are short-term monthly expenses. We want to bring in more inventory. We have problems with cash flow, and that's difficult, boy. Or borrowing funds because the cash flow is in problems. That's going to create more problems, at least as far as I'm concerned. Long-term, replacing capital equipment. We might want to merge with somebody. We might want to acquire somebody. New facilities, etc. So those are things that we need. Those are big ticket items, if you will, looking on the right-hand side of the screen as you look at it, whereas the other ones on the left-hand side are not as big a ticket items. That's not meant to diminish their importance. They're just not big ticket items. Short-term financing, we can do trade credit. We're buying things now, paying for them later. Promissory notes, we can do things of that nature. Other types of short-term financing, asking for money from family and friends, that's for small businesses. And you have to be careful here. You can lose family and friends very quickly, or you can sour those relationships when in fact there are issues. And if you don't put things in writing, that's going to come back to bite you in the ankle and other places you don't want to be bitten, because somebody said, well, you promised me this, and then it didn't happen. Put it in writing. Families don't like to do that, but it's the best course of events for everybody. Banks have resisted lending money to small firms ever since the recession hit in 2007. It's very difficult for small businesses to get money. They just don't like to lend it, and they've been sitting on it. So it's something that's going to be very difficult. So that puts the small business people in some kind of a quandary as to where do I get money? And so you can do things like secured loans. Remember, secured loan is backed by something, usually property. Unsecured loans, you might be able to get that because the banker knows you and knows you're good for the money. Line of credit, you can draw this amount of money as long as the bank has it to be able to lend to you. And the revolving credit account, that comes usually from a bank, but obviously there's a fee for that. So it's not something you're going to find very quickly. Factoring is another way that small businesses can get money. This is simply selling accounts, pardon me, for less than their value. Sorry, I lost that. Let's get back here. So the object here is I need cash on the barrelhead, and I've got these accounts, and I'm going to sell them to you. You're going to give me cash, and that's going to help me out. Now, the factoring people are good people, but they're going to charge you more money than a bank does, and mainly because you can't go to the bank and get a loan that you need for operating expenses or something. So you want to turn what you have, a source of revenue, into ready cash, and that's why you go to a factor. Don't think of these folks as being black market people. They're not. They're legitimate business people, but they're going to charge you more money. Commercial paper is another one. Usually amounts of $100,000. Going to have to pay it back in 270 days. Most small businesses, well, I won't say most, but many small businesses don't have that wherewithal to borrow $100,000. Remember, this is unsecured, so unless the business is stable, you're not going to get it. So don't ask for it. I'm not going to talk about credit cards. I discourage their use. Credit cards, what you're doing here, that with a credit card company is lending you money. We don't think about it that way. Make a purchase on a credit card, you go out to dinner. And my wife and I had dinner last Friday night with a friend, and we paid by credit card. Now that bill's going to have to be paid when it comes due. What that credit card company did is it paid the restaurant, and then said to us effectively, we have lent you whatever the amount of the bill was, and when we send you a bill, you have to pay it. Okay, that's fine. If I pay that bill when it's due, which is my what I do on a normal basis, doesn't cost me anything, unless I have to pay for the credit card. Now, that particular credit card I used the other night, I don't pay for. I get one of these days I may have to pay for it because I pay my bills on time. American Express that I also have, I pass a membership fee. I pay X number of dollars a year, and my wife has a card, and we pay X number of dollars for hers as well. Okay, so what they've done, what this credit card company says, they've lent me money. Now I don't pay that in a specified amount of time. they're going to charge me 18 or 20%. And that's a lot more than the bank's going to charge me if I borrowed the same amount of money. Of course, the bank probably wouldn't lend me that money, even if I had a good account there. So all I'm saying to you is know how much a credit card company is going to charge you. Understand that it's a loan every time you make a credit card transaction, and you should pay it on time. That's to your benefit, not to mine. So notice here rates for small businesses grew almost 30% after the Credit Card Responsibility, Accountability, and Disclosure Act was passed. Here's some ways to attract capital, startup capital. Look out for people who will give micro loans, micro lender. One of the things I talked to you is about, well, I shouldn't say it that way. One of the things we mentioned way back in Chapter 6 is talk to the Small Business Administration. Those folks are a government entity, and they want to see you succeed. And help. They may not be able to do anything other than point you in the right direction, but at least they can point you in the right direction. Talk to the Chamber of Commerce. They want to see small businesses succeed. Look to the web and seek out people who they call peer-to-peer lenders. Talk to your vendors. They want to see you succeed too. They might be able to help you raise some cash. Now, you may not be able to raise cash if you don't have a business plan. And people don't know anything about you. So, and of course, if you don't have good credit and your plan is unrealistic, you're not going to be able to get any kind of money. Long-term objectives, you really have to sit down and figure this out. How do you achieve your long-term goals and objectives? And where's the money coming from? It's things we have to answer those questions before we can ever start doing anything. These are the 5 C's of credit. We're looking for character, capacity to repay, capital is being invested, how well the economy is doing, conditions of the economy, and then any collateral that can be put up. I'm not going to talk about that particular slide. Again, they used 3 to 7 here instead of 3 to 5. I prefer 3 to 5, and that's what I'm familiar with. But I wouldn't quibble over this. You know, we've talked about this long-term loan agreement, promissory note. We have to have the wherewithal to repay, and there may be some interest that has to be paid. Remember that there is an advantage here. We're going to talk about this more when we get to Chapter 19 next week, and that is interest paid on loans is tax deductible. Interest paid on bonds is tax deductible. So that's a way to think about whatever you want to do. How do you want to attract venture capitalists? They're going to look to see if you grow. Some venture capitalists don't care about a business plan as much as they care about the idea and the market and a few things of that nature. What they do want to know is number 2, how quickly can we get our money back, and will this investment pay off? Now, I always like to mention a story about venture capitalists. Venture capitalists are good people, but they're in business to make money. That's why they lend money, and they want their money back when they want it back. I have a good friend of mine who's been in the home security business for many years. He's still on a little bit different avenue of it today. About 20 years or so ago, he and a friend branched out and started their own company. And they got some money from venture capitalists, and they were doing very well. And then the venture capitalists came and knocked on their door and said, "We want our money." And Greg and his friend didn't have enough capital working capital to pay them off and then to keep the company going, so they had to liquidate the company. So now they didn't lose any money. But that's the issue with venture capitalists. I don't want to paint them in a bad light because they do perform a good service. But you have to remember, they're in it for the money. And when they see a chance to get their money back, they're going to come and ask for it. So there's other ones you can go to. You can look for angel investors. You can look for some other type of people. Go to the Small Business Administration. That's what they're there for. They're there to help people like you who want to start a small business. Now, the last slide we have here, we're not going to spend, there's another slide after that. I'm sorry about that. We don't like to spend a whole lot of money here, but we do want to call your attention to it. The differences between debt and equity financing. And again, we're going to talk more about this next week. Remember that debt has a maturity date. You have to pay it back. It usually has interest, but the benefit is it's tax deductible. Equity comes from common stockholders. Stock does not have a maturity date. You do not have to pay equity or dividends. And so those dividends that you would have paid can be reinvested in the company, but they're not tax deductible. Notice here the last item, they're paid from after-tax income and are not deductible. Leverage funds, raising funds through borrowing, is going to increase your rate of return. Cost of capital rate of return a company must earn to pay the demands of its lenders. And finally here, we do have one other slide. We may look at that shortly. But this is using debt versus equity financing. This is a slide that I really don't want to spend any time explaining to you, because you can explain it to yourself by looking at it. It is simple math. Do not be overburdened by what is going on here. Simply look at it, see where it is, and where you're going to go. Taking on additional debt, additional equity. And remember, equity is coming from within, okay? And you're not paying any interest and things of that nature. Notice the difference in the equity, okay? Return on return on equity. That's what you're looking for. So this is really something that you have to determine which is best for you. And what we find here is, and I'm not going to go over this, but I'm going to put this slide up here and let you look at it. We went through the worst of times since the Great Depression started in 1929. We've had some sweeping financial regulation, which I think, without fear of contradiction, is going to be rolled back. One of the problems we've always had in this country is we have a yin and yang between what some people think is too much regulation and what other people think is too little regulation, and we never can seem to get a happy medium, which is very important. So we may see government intervention and involvement lessened. That may come at a detriment to those of us who are consumers. I'm not here to make value judgments on it yet. I am concerned as an individual of lessening regulations, because sometimes that lets the fox in the hen house. So we have to watch. We have to be careful. And when we see things we don't like, we have to let our congressmen and women and our senators know about it. Well, I certainly apologize for all the technical difficulties we ran into tonight, and some of the lecture is not going to be recorded. And again, I apologize for that. But I do want to repeat the question for the lecture discussion question for this evening, because this is being recorded. I will be able to get this uploaded to Campus Web. In your own words, explain why businesses need operating funds in 4 key areas. Again, in your own words, explain why businesses need operating funds in 4 key areas. You will find that in Chapter 18. Well, I thank you for sticking with me tonight through all these ins and outs and ups and downs. Appreciate you paying attention and adding some kind words to me. And thank you for your attention. I'll be back to speak with you. Next week may not be until Tuesday, I won't know that until sometime later this week. We have our accrediting agency coming in on Monday and Tuesday next week, and I have to be available. And I may not be able to get to Monday, so we may postpone till Tuesday, but I'll let you know as quickly as possible. Again, thank you for your attention, and good night.